Hi, guys. Welcome back to the Your Home at Billings podcast. Today, we have a special one for you, Doug Ross, the mortgage loan officer. Doug, how are you doing today?
I am doing great. Thank you for having me. Excited to be here.
I'm stoked to have you here. So, Doug, let's jump right into it. So, what is something that people think will disqualify them?
I think a lot of people have this expectation that they have to have really, really top tier credit scores to get a decent loan. But you'd be surprised at how low some of these loan programs will go for first-time homebuyers. FHA products will take you as low as a 580 credit score.
Wow.
Conventional can go all the way down to a 620. So a lot of times people have this expectation that I have to have all my ducks in a row before talking to somebody, but it's just not the case. And lending allows us to go pretty low to accommodate a lot of uniqueness when it comes to credit scores and other challenges people might have.
Wow, so it's really dependent on a particular individual scenario. Is that right?
Mm-hmm. Scenario, and then different loan products make allowances more generously than others.
What surprises first-time home buyers most about the buying process?
I think a common surprise that I come across is how simple it really is. I think and the fact that it's free. Like a lot of people are like, oh, I don't want to talk to a lender, all this pressure and expectation.
Yeah.
There's really none of that. I mean, it's more of an educational process. You sit down with someone, they're going to go through your credit report together. They're going to go through your credit, income, and asset docs. And then they're just going to educate you on what loan programs are out there, the pros and cons, and just empower you to make the right decision for you. Right? The process is free. There's no pressure to have to get into contract anytime soon. It's just a learning process. And so a lot of times I find myself having to assure people that, hey, my time is free. It's okay. It's going to be pretty painless. And if you decide to do nothing after this, that's okay too.
Yeah, interesting. So if someone's coming in and they're like, man, I am interested in looking at homes. Should I get pre-approved first before I look at homes?
100%. Right. So once you find that house you love, you get emotionally attached. And there's danger to that if you're getting emotionally attached to a property and you have no idea if you qualify. And if you do qualify, what kind of monthly payment you're looking at for the next 15 or 30 years. And so what I find is when folks come to me already attached to a property, they're doing mental gymnastics to try and get all the numbers to work instead of preparing ahead of time and understanding, all right, I don't want my monthly payment to be more than $3,000 a month. So what kind of a price point is going to create that kind of monthly payment so I'm comfortable and not house poor moving forward?
Let's hit the flip side of this. So someone who's like, I really want to get into a home, let's talk to a mortgage lender first because I know that's the first step, right? And then after that, they spend so much time away that their pre-approval notice is gone. Do they have to come in and get pre-approved? And is the process the same, or are there things that are going to change throughout that?
Good question. I get that all the time. How long is this pre-approval good for, right? I'm not ready to look for 3 months or 6 months, and so I'm not ready to talk to somebody yet. I always encourage you, and this might be biased, but talk to the lender earlier than later because there might be skeletons in the closet that we discover together, and that gives you the next 6 months to work through those things. Maybe your credit scores are a little lower on a mortgage scoring matrix than what Credit Karma is telling you. And so it's better to uncover that sooner than later so we have time to go through maybe some credit counseling or some advice to pay down some credit cards or settle on some collections to get those scores up to the loan products that are a little more attractive to you. In terms of how long the pre-approval lasts for, I usually say it's as good for as long as your credit, income, and asset situation remains the same. So if your income doesn't change, if your credit scores remain consistent, and you don't take on new debts, the credit or the pre-approval is really good indefinitely. And there's this common document online. It's called the 10 pre-approval commandments. And they're like the 10 things to avoid doing after somebody pre-approves you. It's something I go over in my buyer's consult, but it's public information. And I'd recommend consulting that as well, because those are really the 10 things that will invalidate a pre-approval once you get pre-approved.
Wow, interesting. So Doug, what are the 3 most common mistakes you see from someone coming in and wanting to get a home loan?
So I would say the first common mistake is waiting too long. Falling in love with the property before they understand the numbers or if they can even get it. And that can be pretty disheartening to spend the next 3 months looking at houses, thinking that you can get a particular price point only to find out when the day comes you're ready to make an offer that you've been wasting your time and your agent's time. Or maybe you do qualify and the payment's just so overwhelming. And I've seen this happen too, where you get into contract with all of this nervous anticipation and excitement because you want the house, but halfway through escrow, you come to the conclusion that this is just too much for me. Like, I didn't think this through. I rushed into this, and now I have all this pressure, and I paid money in inspections and appraisals, and I'm out of pocket all this money, and now I'm disappointing my agent and the seller and the lender because I'm not able to fulfill what I promised to fulfill when I got into contract. And so biggest mistake is waiting too long, right? Get pre-approved, understand the numbers before you go falling in love with houses is number one. Number two is don't get too discouraged if you don't get the feedback you were hoping when you do try and get pre-approved. I see that a lot where someone will come in and they think their credit scores are a certain amount, and I pull it on a mortgage matrix and it's actually 50 points lower. And then we're like, okay, well, if you pay this card down and pay off that collection, you can boost up 30 to 50 points over the next couple months. But there's like this deflation of the balloon that happens. And then they end up, I can't get a hold of them after that, and they're just like discouraged. And so try and look at a pre-approval as feedback, right? I'm just trying to learn where I sit. And if I follow my loan officer's advice, then I can get to where I need to go. Right? There's plenty of banks that unfortunately will just say yes or no. Sorry, on to the next one. We are going to coach you through whatever you're lacking to get you to where you want to be. And if you can try and take that humbly and follow the instructions, you'll get to where you need to be if you're not there already today. And sometimes that can be hard for folks. So number two is try not to get discouraged if you are a little surprised when you do talk to somebody. Number three would be after getting pre-approved, as you mentioned, there's a gap in time between, hey, I'm pre-approved and I found a house. And sometimes that can be 6 months, could be a year. I pre-approved someone for a year and a half. And life happens during that year and a half. And if you start making financial decisions that invalidate your pre-approval without talking to your loan officer, once you go into contract on that house 6 months later and, oh, I actually bought a truck and it's got $1,000 monthly payment, right? Or I had a credit card late 2 months ago and my scores dropped 60 points. Or my car broke down and I spent all the money that I had saved up for the down payment, so I don't have that anymore. But don't worry, my buddy Joe's he's gonna spot me the money. Yeah. Stuff like that are things that you should probably talk to your loan officer ahead of time, and then maybe put the house search on hold for a bit because I'm not where I was before. So those 10 pre-approval commandments are pretty important to follow once you've been pre-approved to ensure that you're not endangering your pre-approval when the time comes to actually get that loan. So that'd probably be mistake number 3.
Wow, yeah. And I want to touch on that third one you mentioned. Someone comes in, they get pre-approved. 3 months down the line, they see you again, and they have a brand new truck, right? From then on, what do you do? What are your recommendations?
So at that point, we have to pivot, right? So what controls how big of a loan a borrower qualifies for is this thing called a debt-to-income ratio. And so if your income situation changes or your debt situation increases, you're kind of sucking up room that the mortgage was taking up, and now we don't have room for the mortgage. And so it's just a matter of reevaluating the numbers, right? There are plenty of people who qualify for more than they actually want. And so in those situations, it's okay, right? We had extra room on the debt-to-income ratios. But if you're in that scenario where you are maxing out your debt-to-income ratios, and a good loan officer is going to let you know these things like, hey, we're a red line in this one. Like, we cannot go any higher on debt, so please be careful. If your debt situation changes by $100 a month, you may not qualify for this. But there's plenty of situations where people underqualify and they can get much more house, and then it's a less big deal if they want to add some debt. So again, it's that education factor of understanding, as a borrower, do I have space to get some more debts? And my big feedback when I tell people is just call me first, right? If you're about to go to the dealership, your car breaks down, just let's go over some hypotheticals, right? You can still get a $500 monthly payment and qualify for the same home. And that's good information to have heading into that dealership before you sign the contract, and now we're backpedaling.
Right, Doug, you mentioned debt to income ratios, right? But how is my credit really affecting how much money I can pull out or my interest rate?
Good question. So your credit scores play a big role in, the purpose of a credit score is they're the system of predictive analytics that determine a borrower's ability to pay their debts on time and attitude towards their debts. That is like the definition of a FICO credit score. And so that credit score is an indicator to future lenders of your ability to repay. And so naturally, if your credit scores start to get on the lower side, lenders are going to price in that risk with higher interest rates. And some loan products are no longer interested in taking on that particular borrower if their credit scores are below a certain number. So it absolutely dictates the types of loans you qualify for and the interest rates that attached, because it's all risk driven. And on paper, a lower credit score is a higher risk to a lender. But that's not the only factor, right? There's a lot of factors, and maybe we'll get to that later. But I usually say there's 3 factors to a pre-approval: credit, income, and assets. Those are the 3 things that we look at as a lender.
So when we're talking about So you said credit, income, and assets. And assets, are you talking about the debt to income ratio, or is that included in there?
So the credit is going to be the credit scores we've been talking about,
Right.
right? So we're looking at, your debts, collections, all that good stuff. Income, we're looking at how much money you have coming in versus how much money you have going out. And that's kind of attached to the credit report as well, where the credit report tells us the money going out in your job, and pay stubs and W-2s and taxes are going to show us what's coming in. And so that's going to, so the credit and income are going to influence those debt to income ratios. Assets is just how much money do you have in the bank? How much money do you have in your 401k? How much money do you have set aside, prepared to put towards this house? Because a lot of people think, I need 20%. You absolutely don't need 20% as a first-time home buyer. 20% is a magic number because your mortgage insurance goes away, and now you're not paying this monthly penalty for not putting 20% down. But there are plenty of first-time home buyer products and things that allow you to get a mortgage with no money down. And so, but how much assets you have in the bank when you come to get pre-approved determines the types of loans we're going to talk about. Because if you have no money in the bank, you got one option: down payment assistance.
Yeah.
But if you have 20% saved up, then you've got many options. You can go conventional, FHA. There's so many loans that will take you. So the higher your credit scores, the more stable your income, and the higher income and the more assets you have, more doors start to open up in terms of lending options you have available to you.
Let's say the first thing I do is come up to you and I say, hey, I want to buy a house. What is the process from there on out to approval, and how long does that take?
So generally speaking, there's pre-qualifications and there's pre-approvals. So I typically deal in pre-approvals. So a pre-qualification is a conversation in a credit pool. That's what I usually call it.
Yeah.
So if you call sometimes a bank and you're like, hey, I want to get pre-approved, and they're like, okay, well, how much do you make? They type that in. All right, well, how much does your wife make? And they're just asking you questions, and then they pull your credit. And they say, okay, based on your credit pool and how much you've told me and how much you've said is in the bank, here's what you qualify for. The problem is nothing has been verified. And I usually say that a pre-qualification is barely worth the paper that it's printed on. Now, a pre-approval is when the lender actually does that same application with you over the phone. You tell them everything, but then they're asking for everything that a mortgage underwriter would need to review. And they're reviewing that ahead of time to make sure you can get the loan that you're trying to get. And so I'm asking for pay stubs and taxes and W-2s and bank statements and IDs. And I'm basically pre-underwriting that file so that there's no surprises when you come try and get the loan. Because unfortunately, you might make 6 figures a year, but I might not be able to use the 6 figures a year. If you're 1099, if you're self-employed, if it's commission-based, there's all kinds of rules that Fannie and Freddie dictate we need to follow as lenders. And so if I'm just taking your word for it, it's almost like you're setting yourself up to potentially fail, which can be devastating to someone. I was talking to a real estate agent. She works exclusively with veterans. And there's a particular veteran that was finally getting his life together, right? He was living on the streets, had some addiction issues. He's like, I want to get my life together and buy a house. And he was all set, and he got a pre-qualification. And so they were looking for months, finally went into contract, dream home. And then a week before close, bank's like, sorry, after reviewing your documents, you don't qualify. And unfortunately, this veteran who was trying to keep his life together just tailspin, back on the streets, moved back to where all the bad influences were, and it completely changed the trajectory of his life. So making sure that you have a thorough lender you're working with that goes through things, and it might take a little longer. The general process is you submit an online application, you upload the docs package, lender reviews it, and then you sit down together and you talk about what it looks like. So I usually 3 simple steps: application, give me some docs, and then we sit down and talk. And that can be done in a matter of hours if it's a rush. That can be done over a few days. Not everybody has the full docs package at their fingertips.
Right.
And that typically takes the longest. And so I usually tell folks we could do it online, fill out an app, and we do a Zoom call after I have a chance to review it, or come to the office, bring the docs with you, and we'll knock it all out at the office. But an hour or two, if you have a full docs package, it really doesn't take that long.
Wow, that is really impressive, really surprising. Maybe I wasn't prepared. So, Doug, I know we kind of already touched on this next question, but name the three biggest factors that contribute to your loan amount, right?
Yeah, so we're talking about the big 3. So the big 3 qualifications is credit, income, and assets. So the best thing a first-time home buyer can do is go to work on their credit, number 1, right? Let's get those credit scores as high as possible. No, they don't have to be an 800. But having a 675 instead of a 575 makes a huge difference when it comes to the types of loans you have access to. So paying down your credit cards to less than 25% balance to usage ratio, settling on your collections, creating more good active lines of credit than you have bad is key to getting your scores up. So focus on that for the credit front. Number 2, the income front. Just making sure that you're the most valuable employee you can be, right? Show up early, go the extra mile, right? That's going to create job security. That's going to have better income coming your way in the future. And try not to switch jobs so often to where the last 2 years you've worked 7 different jobs. That doesn't look stable to a lender, and it makes them a little nervous. So the income factor is just going to work on yourself to be the most valuable contributor to your job, your boss, the economy as you can be, and then you're going to have a stronger income factor. And then number 3 is assets. The more you save, the more doors you have open to you. You don't have to have a 20% down. You don't have to have a down payment at all. But if you don't have a down payment, you have one option, which is a down payment assistance program. If you have a down payment, now you have 2, now you have 3, now you have 5 to choose from. And options, generally speaking, are a good thing. Right? If you come to me with a 580 credit score, you got one option. You have an option, which is great, but it's only one. And so if you work on the credit scores, if you work on the income factor, if you work on the assets, more and more lending doors start to open, and now I've got options, and I think everybody likes options. Yep.
So Doug, you touched a little bit on down payment assistance. Can you kind of tell me a little bit about that? Is that frowned upon? Is it just another avenue that allows them to get into a home?
Yeah, so there's all kinds of you have state-funded down payment assistance, which in the state of Montana is the Montana Board of Housing. State of California, they have CalHAFA. So you have your state programs, which are pretty big and typically going to be your better deals. And then a lot of your lenders are going to have private down payment assistance where they're going to offer. And typically down payment assistance comes in the form of a loan that they give you, a second loan to cover the down payment. Some of your state programs, if your income's low enough, that loan can be forgiven over time and it doesn't even have a monthly payment. But there's additional factors you have to look at with a down payment assistance program. So you take all the normal rules that an FHA loan has and you add about 15 more, and that's a down payment assistance. So now they want their credit scores a little higher. They want your debt to income ratios a little lower, right? They're going to verify your income history is going to look at with a little more scrutiny. Generally speaking, a little bit more challenging to get, but definitely not impossible. Whenever you're working with a government entity, there's more hoops you got to jump through, and your escrow is going to take a little bit longer. Generally speaking, I mentioned that down payment assistance is rarely free. So there's typically going to be some kind of a catch to some of these assistance programs. Generally speaking, your origination fees might be a little higher on an assistance program. Sometimes the rate isn't as competitive on an assistance program as it would be on a normal product. And so there's a give and take of any loan program out there. But if it's going to take you 4 years to save up the down payment, maybe we should consider a down payment assistance today so you could take advantage of that equity growth over the next 4 years instead of having to buy against that 4 years from now.
Don't skip this. Here's the code right now. What about for the people who don't have a credit score? What can you do for them?
Great question, right? So no credit score, in generally speaking, right? And I'm always torn in saying this, right? Because if you have no debts out there, you're being responsible, right? I'm really trying to not have any debts. I'm doing it right. I'm debt free. The problem is if you don't play the FICO game and you don't have active lines of credit that are being reported, then FICO will zero you out. And no credit is the same as poor credit, unfortunately, because you're kind of a wild card and they have no idea how to establish your ability to pay your debts on time, your attitude towards your debt, again, what the definition of a FICO score. Now, luckily, there are programs out there on VA, there are programs out there on FHA that do allow you to still get a mortgage with no credit score. It's called a manual underwrite, and I have a couple of lenders that specialize in that. Now, if you have no credit, it's a little more complicated because the overlay there in the mortgage industry is you have to provide 2 to 3 non-traditional lines of credit, meaning 2 to 3 lines, 2 to 3 bills that you're paying that you can show I've been paying on time for the past 12 months. Sometimes that's a lot of paperwork, right? Because if I got a cell phone that I'm paying, I have to show the old bills and show my bank statement showing it coming out. If it's rent, I have to prove it and maybe get a rent verification if it's car insurance. But sometimes that can be challenging because sometimes people who don't have credit also have no debts at all that they can show they've been paying. And if that's the case, it's going to be really, really hard to get any sort of a mortgage. So understand that alternative lines of credit are an option for those that don't have credit scores. It's a lot more paperwork, a little more work, but you can still get a mortgage.
So Doug, I want to touch back on something you mentioned earlier. You said no credit is as bad as bad credit. But I've always heard no credit is better than bad credit.
So it depends on the industry, right? So I can only speak on behalf of the mortgage industry, right? Auto loan industry might consider that differently. Generally speaking, when you don't have a credit score, you're going to have a really hard time getting you're going to have a more challenging time getting a mortgage, and you're going to have a challenging time renting a car and things because a credit score is an indicator to a future creditor of your ability to repay debts. And without that, it's a question mark. We really don't have any way of establishing your capacity to pay on time. And so that's really the predictive analytic that gives future creditors some assurances that this is a good investment they're making in you. And without any sort of predictive analytics behind you, they have no assurances.
Doug, how long have you been doing this?
Yeah, what got me into it?
Yeah, what started it? Tell me about your time.
So what inspired me to get into lending was, before getting into lending, I was a project manager for the Army Corps of Engineers. And I had an engineering degree, so very numbers driven, but I learned the value of good communication in the Army Corps of Engineers. As a project manager, you got to make sure all the government entities and the contractors are all working together. We're on the same page. We're catching problems early. And there's a lot of hand-holding to make sure we get to the finish line on time. Now, when I was in that job, we got our first house, and we were super excited. But I was a little disappointed with my experience with my loan officer. Unfortunately, I felt like he was making a lot of decisions for me, didn't really educate me on what was out there. It was more like a conversation in a credit pool. Cool, well, you qualify for an FHA. Here's the rate, here's the payment. Good luck out there. And he didn't prepare me for a lot of things that were in store. Like, I had to pay for an appraisal. He didn't go over what closing costs were. And so I was blindsided left and right throughout this transaction because I just wasn't prepared. And what I've learned in working for the Army Corps of Engineers is that all frustration comes from unmet expectation. So if you can set the right kinds of expectations for all the parties involved, we're in for a smooth ride. And so as a loan officer, and I guess understanding the skills I learned as a project manager for the Army Corps, I thought to myself, I could probably do a much better job and help people be way more prepared for what's in store when they go to buy a house. And eventually, after some time of thought, we merged into being a loan officer, and I've been doing that for a little over a decade. But I bring that same philosophy of a project manager, right? Good communication. Let's make sure the agents, the title company, the borrowers all understand what's going on, right? Let's educate you on what an appraisal is, how much it could be, and when you're going to pay for it. What are closing costs? Who's going to cover those? And so spending a little more time on the education and the communication front goes a really long way for borrowers, because then they feel like they're in good hands. They're getting taken care of, right? Don't worry, the appraisal came in low, but Doug prepared me for this. I understand what this means. I'm not freaking out when that comes in at 7 o'clock at night on a Friday and I got to wait on a Monday because my loan officer works banker hours, right? So it's a very different experience. The loan officer can really make or break how stressful the transaction is based on their level of communication and education up front before the emotion hits. My big thing is educate before the emotion hits, and then you're going to be prepared.
What was the thing you said? Your motto.
Oh, all frustration comes from unmet expectations.
All frustration comes from unmet expectations. This is huge. Apply this to your life. What makes you different from other loan officers or from like a bank?
Good question. So I think what makes any loan officer different from another, there's a couple things you want to look for, right, in the pre-approval. You want to look for how much time they're taking to educate you on things. Right? If it's just wham, bam, next one, here's your FHA, go. You want to look at how much they're preparing you for the process. Do they answer the phone when you pick them up, or when they call you? I mean, unfortunately, when you're working with a big bank, you're going to run into banker hours, right, 9 to 5. And if you call me on a Saturday morning, dude, I'm not working, right? It's going to the bank. And so I think one of the things that allows a mortgage broker or a direct lender a level up is that some of my best clients have full-time jobs. They get off at 6 o'clock. So I'm available at 6, 7 at night, right? Because that's when you're available. So that availability to have that conversation on a Friday night before you make the offer on that house to make sure you understand the numbers, or something comes up on a Saturday in inspections and you really need to talk to somebody who can bring some assurances of how this is going to affect the loan, right? Those can go really far. So availability, communication, education is really the pillars of my business, and I think what sets me apart.
That's awesome. So Doug, I also know that you speak some Spanish, right? Fluent in Spanish, is that right?
I do, yes.
Doug, do you want to close us out later
with some Spanish?
Listen to the podcast in Spanish,
right? I have to do the whole thing again in Spanish, though.
Yeah. We don't need a translator. We got Doug over here.
I think the only other thing too is that I'm a mortgage broker. We didn't really talk about that, but people have heard that term, but there's not a lot of understanding as to what that actually means. So a mortgage broker means that I'm not handcuffed to just one bank. Right? You go to a big bank, they're going to offer what that bank has to offer. But you're not going to go to Wells Fargo and have them offer Chase products because they're different banks, right? You got to offer what your bank's offering. Whereas in the brokered world, we work with about 50 different wholesale lenders. And so there's a lot more flexibility when it comes to the types of products we can offer. And we can accommodate the uniqueness of every different borrower situation, right? If you have low credit scores, I got some guys that really specialize with working with folks with lower credit, right? If you're a veteran, I got my 3 VA guys that are awesome at what they do. Down payment assistance, got some guys that are really good at down payment assistance. So my job's a little harder in that sense because I have so many more underwriters and doc dryers and back office systems that I'm trying to work and master. But I love the flexibility of saying no less often, because, hey, let's pivot and go with this non-QM product where it's stated income or some unique Wild Westy thing that's still out there. So we can say yes a little more often than maybe someone that has a certain box you have to fit in. And if you don't, the answer is no.
Wow, that's awesome. To be able to allow so many avenues to go down in order to make sure that a yes can be had. So Doug, let's talk about some of the interest rates, what you kind of see in the market. What are we expecting for 2026?
So 2026 is kind of an exciting year, right? The current administration has come out and said that they're going to be dumping $200 billion with a B into the bond market to help improve interest rates. We also have the changing of a Fed chair, which is a big deal. There's a lot of mixed feelings about Jerome Powell and how he's handled things. But this new Fed chair that's supposed to be taking place in May is supposed to be a lot more on board with cutting rates when appropriate. And so we are anticipating as an industry that rates are going to start coming down. Now, how much, we don't know. I mean, in 2025, if you look at the performance of 2025, at the beginning of 2025, your average conventional product was low sevens, and by the end, it was low sixes. So we came down a full percent in 2025 without any sort of any help from the current administration. But with this $200 billion focus, I see rates coming, maybe doubling that in terms of how far they're going to come down. Now, when we don't know, but that all this, and it's hit the news, right? People are asking me, people are like, hey, should I refi? It's like, it's a hot topic right now, which is exciting. And what I'm starting to see return into the mortgage industry, into the real estate industry is optimism. There's more optimism. People are hopeful that we're going to see a lot of improvements and relief when it comes to the rate front.
If someone's ready to buy a home and they want to take their first step to it, how can they reach you?
So many ways, right? You can give me a call. You can send me a text. You can email me. My phone number is 916-259-6302. My email is ross.doug@outlook.com. My website, Instagram, social media, like there's so many different ways to get a hold of me. And I'm more than happy to have a conversation. And please, like I mentioned before, there's no cost to this, right? There's no pressure. It is just a learning experience for you to understand where you're at. And if you know you're not where you need to be right now, that's okay too, because we might be able to find other things that you can work on while you're working on the credit scores, while you're working on getting some job stability, or while you're saving for that down payment over the next 4 months. Let's make sure your credit is as strong as possible, that your income scenario is as strong as possible. And getting that early feedback is pivotal in that process.
Hey, Doug, for those Spanish speakers out there, how can they get a hold of you?
Oh, okay. I'm going to answer this one in Spanish if that's okay.
That's perfect.
Para los que hablan español, estoy aquí también para ayudarles. Me pueden mandar un email, me pueden marcar por teléfono. Mi número es 916-259-6302 y estoy aquí para ayudarles. Gracias.